Thank you.
Right. Okay,
We're good, Mike.
thanks. Okay. Good morning, everyone. I'd like to call to order the New York City Audit Committee meeting of Wednesday, January 28th. And I'd like to thank everybody for attending this meeting, whether it's in person in the municipal building or on Zoom. And everybody be safe. It's cold out there. So, first item, I'd like to have Katrina, the secretary, call the members roll.
Good morning, everyone. Our private members, Michael Spitzer, Chair.
Present.
Larry and Angelo.
Present.
Mark Kaplan.
Present.
Marsha Van Wagner.
Present.
Our public members, representing Mayor Zoran Mandamni, Sarah Wong.
Present.
Representing Comptroller Mark Levine, Jacqueline Thompson.
Present.
We have a quorum.
Okay, thank you. And I think if I recall, Katrina, we have to say that we are authorized to have this meeting by Zoom based on the guidelines that were prepared for us going back to COVID. Am I
Right, in our
correct?
resolution that was dated in November. Yes.
Yes. Okay. So let's, next item on the agenda is the acceptance of the draft minutes of the December 10th, 2025 meeting.
I move them.
I second.
Thank you. If anybody has any comments or nits, just please forward them to Katrina, the secretary, and she'll take care of them. Okay, the first presenter to the audit committee for today is the New York City Employees Retirement System. Can you please, whoever's going to be talking, identify yourself and identify all the parties that are joining you from your organization or any auditors uh, that are here or on Zoom or in the room that are tied to your organization?
Yes, can you hear me? This is Chen
Yes.
Gang speaking from Nighters. Can you hear me good? Yes, okay. So I'm the Director of Finance from the New York City Employees Retirement System. And good morning, everyone. I'd like to introduce our other NICERS attendees. So here we have Charles Barkley, the Chief Financial Officer. We have Dan Nunez, the Chief Information Security Officer. We have Herman Berno, the Director of Internal Audit. And I also like to introduce two of my newest members. I have Shamika Ian, the Deputy Director of Finance, who joined in September last year. And we also have Alice Mann, the Finance Administrator, who joined in August last year. Grant Thornton were still NICERS independent auditors for fiscal year 2025. There have been no findings today that have impacted NICERS financial statements. Similar to last year's, NICERS received two awards. One is the GFOA Certificate of Achievement, and the other is the Public Pension Standards Award for Funding and Administration from the Public Pension Coordinating Council. They're presented in the NICERS most recent ACFR, published in December 2025. I would like to share that this year makes a huge milestone for NICERS. For the very first time, we have fully automated the ACFR production process using a new financial reporting tool called Gravity. Now, with Gravity and the support from the Office of the Actuary, the Comptroller's Office, and our external financial auditor, Grant Thornton, we have reduced manual workloads, enhanced data accuracy, and modernized our workflow and reporting cycle. This year, our ACFR was released on December 15th, 2 weeks ahead of schedule. So here I want to personally thank Frankie and Annie from the Actuary's Office, Lynn and Daniel from the Comptroller's Office, Bureau of Asset Management, and Sharon, Will, Patsy from Grant Thornton, and my very own accounting and financial reporting team. You are truly amazing. So this accomplishment is a great example of what NICERS can achieve when we modernize our processes, work collaboratively across teams, and remain focused on delivering timely, high-quality results for our members. So now I'm going to pass it on to Shamika and Alice from my team for them to present the financial highlights.
Hi, everyone. Good morning. First, we're going to go over the assets, and you can find that on pages 116 and 117 of the ACFA. Can you hear me okay? Oh, okay. Okay, so hi, I'm going to repeat. My name is Alice. First, we're going to talk about the assets, which you could find the information on pages 116 and 117 of the ACFA. QPP net assets as of June 30, 2025 reached $93.1 billion, up from $86.9 billion at June 30, 2024. NICER's 2025 financials show VSF net position as of June 30, 2025 at $1.2 billion, up from $1 billion at June 30, 2024. The combined QPP and VSF net position is $94.3 billion. That's an increase of about $6.4 billion from 2024, which was $87.9 billion. Moving on to the market return, which you can find the information on pages 185 and 186 of the ACFA. Total pension fund returned 10.05% for fiscal year 2025. And that's less than the NICERS policy benchmark of 11.66%. Domestic equities, which account for about a quarter of the total portfolio, returned 14.08%. That's less than the Russell 3000 benchmark of 15.3%. Total world, excluding USA and EAFE, makes up about 10% of the total portfolio, and that returned 16.17%. Emerging markets, constituting about 5% of the total portfolio, returned 14.13%. The total fixed income segment holding is 38% of the total portfolio, and that returned 7.3%. Private equity return was 4.48%, and private real estate was 1.7%. And you could find that on page 191 of the ACFA.
Good morning, Shamika Ian. So for the funded status, you can find the plan's funded ratio on page 17, as well as within the actuarial section of the ACFA on page 248. Based on the entry age normal cost method, the funded ratio is 82.2% as of June 30th, 2023. This is the date of the most recent actuarial evaluation. Additionally, on page 17 of the ACFA, you will find the plan's fiduciary net position represents 87.7% of total pension liability for NICERS and the 5 VSFs as of June 30th, 2025. The VSFs in December 2024, the QPP transferred to 4 of the 5 VSFs approximately $7.6 million in benefit payments. And that can be found on page 118 of the ACFA. Based on the actuary's estimate as of June 30th, 2025, the skim payable to the correction officers VSF for the fiscal year 2025 was $157.4 million. And as a reminder, these $12,000 a year payments are guaranteed by law since the calendar year 2019. Okay, that concludes our presentation for the financials. We welcome any questions you may have.
Mike, before we start with questions, I just wanted to have we have representatives from the actuary's office and from BAM to introduce themselves for the record. Thank you.
Good morning, Lynn Fleischman,
Kat.
Chief Operating Officer. BAM.
Do any
Good
of
morning,
the
Anderson Quinn, Office City Actuary.
And Tom O'Hara from the Office of the Actuary.
Thank you.
Mm.
I'm sorry, Mike, can you repeat so?
Yeah, no, it's so we have the actuary. You said you have BAM.
Yes.
Are there any other entities that are in the room or online?
Our auditors, we have Grant Thornton
Yes.
as well.
Who's there from Grant?
GTK. Grant Thornton, can you please introduce yourselves?
Sharon Campbell is here.
Will
Okay,
Richardson.
thanks. Okay, Marla or Mike? Okay.
Good morning, Marla Hummel.
How's
Mike
the
Ryan as
snow
well.
out in California?
It's brutal, I'm telling you. I had to come back out here just to refresh myself.
Okay,
Kyle Chuber is here as well, and we expect to have our IT specialist joining us. He hit some traffic, but he'll be here.
okay, great. Thanks. Does anybody have any questions? I know Mark probably has a number.
The only thing I can find, is there are a couple of capital lowercase of these. How's that for reading all this junk?
I
Well,
had a question. So I'm
okay.
just out of curiosity, when the returns come in, below benchmark, is that like a meaningful thing to you, or is it just sort of like a point of information that doesn't really affect, how you are approaching the investment strategies and so forth? I mean, if that's some of it's that's the controller's office, but
Yeah, that would be BAM here. Dan actually is our investment person who we're waiting for him to arrive. So maybe we can hold off on that for a few
Okay.
minutes. We'll answer that question.
okay.
Yeah.
All right, thanks.
Oh, he's on. Okay. He's walking in as we speak.
But your question really addresses all of the pension, statements. So, okay.
That's true. It's sort of a universal question.
Good timing then, Dan. I knew that was going to be the question. Thank you. So I don't know, Marla, if you want to repeat your question.
Yeah.
Marcia, can you repeat your question? And it's here now.
Yes, sure. So my question was when the returns are, differ, especially are below the benchmark, is that like useful information for you? I mean, reporting the benchmark is sort of I guess it's kind of reporting requirement or a convention or whatever. And I'm just wondering if it's meaningful in terms of how you think about the portfolio.
It is, Marcia, and good morning, and my apologies for the rush in at the last minute here. So we get a lot of value from benchmark returns relative to investment performance. Really kind of comes more at the granular level, at the manager level, where you can draw insights into how an individual portfolio is constructed relative to the benchmark and see where your exposures are. On systems as large as ours, when you aggregate that up, you tend to get more and more market-like performance. There is some information value in that, certainly. I think as you were looking at returns for June 2025, you saw the systems typically underperform their benchmarks. And again, that's largely because the benchmarks are proxied to public market public market benchmarks. So, for instance, private equity is linked to the Russell 3000, a U.S. equity benchmark. Those markets perform particularly well in the last few years, and you see some underperformance. And it's good to understand that, and it raises some questions as to how, reasons why, private equity, for instance, would have underperformed those public markets. But really, it's more policy framing, framing kind of policy concerns and asking kind of broader questions, I guess. So, long-winded way of saying it is important. You typically the application is at a much more granular level, typically than you see than at the plan level.
Right. Okay. All right. Thanks.
Okay, I'd like to have a kind of follow-up question from Marcia's. So is that underperformance? I mean, you're comparing NICERs to the private sector, I guess. And is that being below that benchmark, is that really a function of just being a little bit more prudent than, say, a private sector institution would be?
It is. It depends how you look at it. I personally see it as a matter of construction. By nature, these investments are valued, they're what are called marked to model. So they're valued on discounted cash flows or using market comparables or multiples of earnings, which typically are more steady over time than you would see if the security were trading on a secondary market, right? So it's less subject, I suppose, to animal spirits in the marketplace.
Yeah, and then I guess my last question would be: when the market declines, do we go above the benchmark because we've been more prudent?
Yeah, it is a double-edged sword in that sense, and that's something I like to. I mean, I'm not trying to sell anything, but when you see a big drawdown like we saw in March 2020, for instance, it was kind of a bit of a learning experience. We were predicting our private markets investments were going to go down by some multiple of public markets, but because again of this mark-to-market convention that's used, they sort of soldiered on, and it showed some resiliency within portfolio performance that we weren't expecting prior to that point. So it sort of underlined the point that it works both ways. In a big market drawdown, this saves some capital.
Yeah, that's good. I'm glad. Thank you.
Let me just
Certainly.
ask,
Thank you.
following up on that, I have a long-standing view that when you have a lot of money like this, you shouldn't have small investments. So let me follow up on that with the an investment with hedge funds and international equity. And for this kind of money, to have one segment that's 49,000 or another one that's 864 compared to all the other millions, is there a reason for that, or is it just somebody didn't bother?
Yeah, I think what you're seeing there is when we divest from accounts, some capital ends up being left there to pay off the final quarters of fees, for instance, or occasionally you'll receive some tail payment on of interest or dividends that happen after you've removed the securities. That takes a bit of time to clear out. And eventually it is swept into the general cash account and redeployed within the portfolios.
Yeah, I would just add, so NICERS is no longer in hedge funds, so that small balance, that's the reason why you're seeing such a small balance there.
Well,
that particular event, I think had a certain lockup period that we're subject to.
Well, you have another one for $49,000. It looks odd.
Agreed. Yeah, we can certainly look into it.
Years though. Okay.
The investment fees, am I correct that the investment fees of 435 million plus roughly $8 million? based on the charts that appear on 200 to 206 or thereabouts. Actually, it starts on 192 and ends 206. So it's roughly about $445 million.
It's
I'm
a
sorry,
lot of money.
we're just pulling up the table now.
Yeah, what page was that? Were you looking at? Oh,
I'm looking at commissions and fees starting about page 192 and ending about 206. Brokers'
Yep.
commissions
Okay,
is
it's good.
roughly $8 million. And the investment managers is 436 million.
It's a big number.
Yeah. That includes
Certainly.
alternatives.
Yeah. So a lot of what's driving that, and it's taken a bit of my time to wrap our arms around it. It's a work in progress, certainly. It has to do with the fee structure that you see in alternatives, whereby there are base management fees that we agree to pay on either committed or invested capital, depending on where you are in the investment cycle. And then there's carried interest or incentive fees that are based on performance. The trick with that is that there are a bunch of different payment waterfall processes in place, American or European, that are contingent on the underlying manager divesting from an underlying portfolio company and generating some profit before they charge you that. And what we're finding is that those are lumpy, to say the least. And you can kind of get hit with a large dollar fee at some point during the fund of the life that you wouldn't normally see if it was reported to us under an accrual basis. So the numbers move around a bit, but that is sort of the nature of the beast, unfortunately.
Unfortunately, it looks like a nasty beast.
It's a very it's a very
Or,
big
yeah,
beast.
a very big beast, certainly. It's a big bill like that is also a function of good investment performance as well.
Are the private equity fees included in these schedules, or are they separate?
They are, yeah. I
Yeah.
believe that's what drives most of that total.
Yes.
Well, when you look at there's a vast difference between the fees and the assets under management. For example, there's one here, the assets under management are $500 million, is 500,000, and the other one's 573. One is 14 million, and the other one's 8 million. So there are huge differences here. And you wonder how you stay with the vast differences in performance.
Yeah, that is kind of this reporting convention where we're looking at a point in time. That is one of the peculiarities that jumps out of this. So, if we're looking at an instance where you have a large dollar fee reported over the course of the year relative to a small asset base, it could be the case, and we can certainly look at individual cases for you. But it could be the case that it was a portfolio that had divested some of their underlying assets and generated a lot of profits that accreted back to us in the form of fees, while at the same time, by nature of them divesting those assets, the assets under management at the end of the year had fallen significantly. So again, I'm a public markets guy, and I really prefer those conventions because I understand them a lot better. But the adage where you can divide the fee by the asset base and come up with a rough rate doesn't work out so well for those types of investments.
Well, if I look at this, for example, there's one here for fees of almost $9 million for 573, and then one above it, the fees are $14 million for 500. So if you're trying to tell me something as an investor here, uh, you need to explain that vast difference in a fashion that makes it meaningful. Otherwise, just a bunch of numbers.
Mark, what page are you looking at?
93. That's one that stuck out in my mind. There's one where the fee in dollars was for $14 million, and right underneath it, for more assets, it was 808 million for
Yeah, but
more.
the assets are in thousands. So you really have to add three zeros to these assets.
I understand that, but it just the assets under management are 500 million dollars, right?
Hmm.
And the fees are 14 million, and for more money under management, the fee is only 8 and a half, 8.9 million. And if we're trying to look
Hmm.
at this thing, try to understand it, that kind of variation calls for some explanation. And probably with all this information, you can't afford to supply that answer. But if I'm looking at money being managed, that one that sticks out so oddly.
So, Mark, your point is taken, and I agree with you that the information value that you're getting from this table as it's set up probably could be better. We'd have to look into the accounting conventions used and just make sure it's in line with how the systems would like to present it. But there are again, we also want to follow best practice. It's possible that we could break out the fees among management and incentives, so you'd understand a bit about the variability there, and you'd see that when your incentive structure, you have a larger fee amount there. You divested from certain companies have been charged for that. We could move to an average asset. An average AUM over the course of the year that would help to match up the magnitude of your investments with the fees that you're being charged. Or we can certainly investigate these as a one-off and just provide you with an explanation if you're interested in understanding the conventions at work.
As far as I'm concerned, I've read these things for many different careers of my mind. And if when I was in the business of watching money managers, that the difference between the two would call my attention to it, and I need to understand it and have it explained. Now, what you've done here is you put a whole bunch of numbers together based on a convention about how it does it, and it raises more questions than it answers. So, what are we trying to prove with this kind of information? To evaluate the performance and how well it's doing. And what I'm saying
Well,
is,
I think the schedule itself is meant to inform the reader on the fees that have been incurred over the course of the year. That the assets under management is there as a comparator. It's an imperfect comparator, but it I think it adds to the story rather than detracts from it. But the main goal of the table is to inform the reader on what the fees were,
well,
what fees were incurred.
that, but
Okay.
Yeah.
with my money, I want to have an explanation why there's such vast differences between performances.
Well, maybe the alternative that you were laying out, I'm sorry, I forgot your name, presenting the
Yeah.
information might be more informative and might sort of speak to some of Mark's concerns.
Yeah, no, it's also, I guess, what is the rate of return that we're getting from, that these companies are giving the pension systems? Because there's a good number of them that the fees compared to the assets under management seem to be very high.
Well,
But,
I guess my
you know,
one is when I'm used to reading these things and I'm not used to not getting an explanation. of what the differences are when they're so stark. Now, maybe you got so much information that you can't afford to spend the time, but no, I made my point.
All right. Are there any other questions regarding the financials or the notes? Yeah.
A lot of
Hearing none. Mark, I'm sorry. Are there any members of the audit committee that are in the room have any questions or comments? All right, looking, the management letter had just one comment. And typically, like as we've seen lately, they all have to do with IT. So does NICE's or the auditors want to make any statement about that comment? Hello?
I'm sorry, which comment it is? Yes, this is Chang. Can you tell me which page you're looking at?
I'm on the second page of the management letter. There was a control deficiency and prod code promotion.
Think.
Mike, GT's IT
Yes.
representative is here. Just give us a minute. He's
Mhm.
settling in.
why
I'm
you
sorry,
look,
what'd you say? He's dialing in or?
somebody ought to proofread this for capitalization of the V in the city. Inconsistent. I'd be happy to give you the markup, but I'm not there. Right.
Pat,
You have no
I'm
Christmas.
sorry. Hello?
I have nothing anymore.
No, no, no. I just wanted to see if anybody from either management of NICE's or the auditors wanted to comment about this comment. Because management has a response, and I'm curious what the auditors think about that response.
Yeah, sorry. We're in the nicers. Nicers.
They're
Yeah.
going to tell you this is the way it's
Okay.
all done.
So as it relates to the control deficiency, so there was a finding where IT personnel had access to security administration, and they had the ability to also develop changes and migrate changes to the production to the prod application. Because of that access results in a segregation of duties conflicts, whereby a user may either intentionally or unintentionally inappropriately create or delete user access or data, resulting in invalid, incomplete, or incorrect transactions. Because of that finding, that results in what's considered a segregation of duties, which is an automatic significant deficiency that's being communicated. Management did have a response that's included in the management letter that we agreed with. I don't know if you want me to read it.
Yeah, so just to add to that, what we would typically see there, if that access is required, we would typically look to see a monitoring control on the back end, whereby on a periodic basis, management was pulling the population of changes and activities performed by those individuals and confirming that everything was appropriate.
So you don't see any issue with management's comment?
No, I don't think so.
Okay.
hmm
I'd like to thank everybody that was here for the NICE's presentation. The next item on the agenda is the teacher's retirement system. And once again, could you identify yourselves and everybody, and this is primarily for inclusion into the minutes. Everybody that's here from your organization and the auditors we already have. We also have included already members of BAM, and we have members of the actuary that have been identified. But primarily just go through who's here from teachers.
Mitchell's settling in. Give him 1 minute.
Mitchell, take another bagel.
Not used to this, but good morning. So Mitchell Fruchter, Assistant Chief Accountant, representing teachers, attending online. George Savacci, Investment Accounting Manager. Barbara Charknik, Manager of Financial Reporting. Nevena Vlachova, Financial Reporting Accountant. Kate Chen, Teachers Internal Audit Director. And representatives here from the Controller Bureau of Asset Management. Good morning, good to see you. Will and Sharon from Grant Thornton, our auditors. So I thank teachers, management, and staff, as well as Grant Thornton, for their dedicated and professional work. Finally, I thank the audit committee for the opportunity here to present our fiscal year 25 financials. So I'm going to go through the financials. I don't know if you have the ACFRA or the standalone.
We have the ACRA.
You have the ACFRA. Okay. Thank you.
You probably have the standalone.
I figured I'd hedge, so I have both. But yeah, the 2025 financial report is the 11th year of teachers combined ACFRA. The ACFRA includes 401A pension and the 403B tax deferred annuity TDA program. So I'll go through my presentation and I'll try to refer to the ACFRA. So on page 29 of the ACFRA, we can see that the teacher's QPP net position as of 6/30/25 was 82.1 billion compared to 74.5 billion for the previous June, an increase of 10%. On page 34 of the ACFRA, the TDA net position increased 7.7% to 52.9 billion. Prior year was 49.1 billion. The combining statement of net position or balance sheet is on page 41. The QPB and TDA combining net position was 134.9 billion. This 134.9 net position also appears on page 212 of the city's annual the city's ACFRA. Okay. So we'll go now to investment performance can largely be explained by investment allocations and to particular market sectors and individual sectors returns. So I think this is on page 67. I'm not sure. Target asset allocations were roughly 34% in fixed income, 27.9% in domestic equity, 17.5% in international equity, 20.6% in alternative investments. I think 67 has the alternative investment breakdown. That's what's on page 67. The asset allocations earlier. Obviously, balance sheet represents the asset allocation. Teachers' investment performance for fiscal year 25 mirrored the returns of the following indices. U.S. equity focused Russell 3000 returned 15.3%. International stocks, MSCI returned 19.3%. The Bloomberg U.S. Mortgage-Backed Security Index was 6.52, while the fixed income New York City Structured Index return was 5.7%. These returns are on 31 of the ACFRA. The pension fund as a whole returned 10.85%. This could be found on page 83, which is required supplemental schedule number 3. In terms of statutory amounts, the QPP accrued 1.2 billion in expense to the TDA returns due to the statutory rate. The QPP statutory interest expense, the total amount was 2.5 billion. There was income of 1.2. That's because the QPP experienced an additional gain of 3.8 billion. So this is all shown on page 33 of the ACFRA. But again, since it was a banner year, it was a good year. Income from TDA investments was more than the statutory rate. The system's benefit payments increased 4.9%. The QPP was 3.5%. Saw a 3.5% increase primarily to retirees. The TDA saw a 7.9% primarily due to larger minimum withdrawals and death benefits. These figures are on page 43 and 44. I think it's basically that's our statement of net changes. So that includes obviously our benefits payments. In terms of current year returns, as of right now, 12/31/25, we see another increase of 6.6%. We're standing at 143.8 billion of total combined assets as of December 31st. In terms of funding status, teachers, we were at 90.4% using the GASB 67 market return level. The ACFRA also mentions in our introduction on page 7 of the ACFRA, the 85.4% using the actuarial method and 2023 valuation data. Teachers received the GFOA Certificate of Excellence in Financial Reporting for 2024 and an unqualified opinion for fiscal year 24 and 25. I'll just wrap up with a few other things. The administrative expense funding expenses is on page 33. It includes modernization, and we in the Secure Act, our TDA we have to build out. We just this month started the Roth on the TDA. So these are things, both we're building out our system and now we have a Roth component. We did have a statutory rebalance higher in the past because it was a 410 million due to a TDA loan related transfer. That's in terms of how we value the assets of the TDA, and there was a loan component which had to be valued. DFS did issue a report on September 5th, 2025. The previous report was back in 2005. I'll just conclude, there, as I always do, in the MD&A, there are breakdowns of financial activity by employer. There's schedules detailing the QPP and TDA cash flow, the percentage holdings of QPP and TDA, and the percentage of how our funds are managed between the controller managing the pension fund and TRS managing the variable funds. So this concludes my presentation and open up to any questions or comments. Thank you.
One comment, and I think I forgot to say it for NICES, is congratulations on getting the ACRIF award from the GFOA once again. But I have a question that's similar to the NICES. It's on page 125. Your fees for the investment managers is almost double what NICES was.
Yeah, it's very high. Again, our assets are more. And I guess, Dan spoke to some of this before.
Yeah, it is a function of the higher asset base. Teachers was north of $100 million for the entire year. And also the timing of when the system was charged incentive fees or carried interest. And again, that creates distortions year over year sometimes, and you'll see it reporting high some years and lower others.
Right, so it has to do with the structure and investment expenses.
And then even the brokerage fees, like NICE's, there was a total for it all, but there's no total at the end on page 144.
Um,
And I realized that,
personally, yeah, I yeah, it's not. I don't think I'll look at what the requirements really are. Again, it's really just to show you the firm's trading and the commission paid. I know I'm not sure how much would be gained from the total, but I'll look at the requirements if the total supposed should be there.
it's more when you compare you to somebody else, and like even the investment managers. Yes, you have more assets, but materially you don't have that much more assets than NICE is, yet your fees are double.
All right. Again, we spoke to again when
Yeah,
the
no,
fees
yeah, I'm
are,
just pointing it out. And like even if the requirements say you don't have it, yeah, I'm basically saying that one entity, NICES, has a total for the investment for the brokerage commissions. You don't.
Okay. Um, Again, personally, I'm not sure how much it offers, but we will let it.
I
Okay,
listen,
no,
experience,
Mark.
you get the larger the pile of investments, the better the deal you can make with the people who are running it for you. And why there should be such a big difference is mysterious to me.
And I think also just, from a reader's perspective, when you see a big column of numbers like that, you like to see, a total at the bottom where a total is appropriate. Like it sort of begs the question,
Yeah,
how much are they paying, total?
well, again, personally on the brokerage fee, it's a standalone as opposed to like the expenses that you were speaking about earlier, which the point of the schedule is to give you the total that ties into the financials. If you give a total here, it won't tie into anything. So like I said, we'll do it just for conformity, but it is a separate type of schedule.
No, but what I've never understood for all of these entities, why there isn't a single place that performs these services and that you can make a better deal with the service provider the more you give them to do. And whether you are all using your buying power to the highest benefit, unless you decide to sit down at a table and go and aggregate.
I'm sure Dan looks at this every day. They're different. I know they're different. In terms of fee structures, it's coming from various components. But
Yeah, and my apologies, Mark. Were we referring to brokerage commissions or management fees?
Both. I've been in
Or
the
both?
business of doing both, and I know that the more money we used to give us, the better the fee arrangement was from the standpoint of the people whose money we're investing. And I wonder whether
Certainly.
these people are aggregating that when they sit down at a table to determine fees.
Sure. Well, let me I'll answer each a little bit differently. The brokerage that the portfolio incurs is a function of our third party managers' trading activity. And those managers have networks, unique to themselves, where they seek to, get best execution and make markets in certain places. What you see here is an aggregation of that, but there's obviously, that's supporting, several dozen investment managers, each executing a unique mandate within the marketplace. If we move on to the management fees that the systems incur, so what we're paying to those third-party managers, I can say that we follow that fairly aggressively. In the public market space, when we contract with an investment manager, we are negotiating fees on behalf of all 5 systems in aggregate. So we're trying to negotiate fee discounts based on that size. In some limited instances, we will have commingled portfolios, meaning that more than one system participates in a market-facing portfolio. And the idea there is that you gain a bit of scale in terms of trading activity and brokerage that you would pay. And then if you look in the alternative space, we again we pardon me, I've got a frog in my throat. We are looking for early close discounts. We aggressively negotiate the fee schedules beyond what you'd normally get from a rack rate, and we use size to our advantage there as well. In addition, we try to lean into co-investment opportunities, which often have economic advantages in terms of fees and carried interest.
So in effect, you're mindful of these issues.
Certainly, yeah.
Okay, as somebody who once was in the business of selling these things, I know what can happen to the provider if the customer allies with other customers.
All right. Does anybody else have any questions, comments, issues?
I think it would be nice if they managed to call the city with a capital Z, but who am I to keep raising that issue?
So noted. Since there's no other questions on the financial statements and there's no comments in the management letter, I'd like to thank Mitchell for his presentation and be safe. Okay, next item on the agenda is New York City Board of Education retirement system.
I got it. Right on the first page, they got the lowercase t.
Good morning, everyone.
Okay. Could you please identify yourselves?
Maybe a little louder.
Yeah, is it better?
A little closer.
Okay. Is it better now?
Mike, can you hear Chitra?
Yes.
Good morning.
Okay.
Good morning.
Good morning. Good morning, everyone. My name is Chitra Subramaniam. I'm the Director of Fiscal Operations at BERS. Joining me today is Mr. Qazi Ahmed, Deputy Director of Fiscal Operations, and Mrs. Zifazli Ade, Director of Internal Audit. Our auditors are from Grant Thornton, represented by Ms. Sharon Campbell and Mr. Will Richardson and the audit team. Thank you for the opportunity to present the key highlights from fiscal year 2025. I'll begin with the major legislative developments that shaped our operations this year. Chapter 721 of the laws of 2023 was signed on December 8, 2023, and became effective July 1, 2024. The law mandates automatic enrollment into BERS for all eligible employees unless they opt out within 90 days of employment. As a result, we saw a significant increase in membership with approximately 24,000 new members joining BERS through auto-enrollment during fiscal year 2025. Under the Federal Secure 2.0 Act of 2022, Roth TD options became available beginning January 2024 for participants meeting certain income and age criteria. BERS expanded this opportunity to all TDA contributing participants. We implemented the ability for the members to make Roth contributions directly to the TDA program, and we expect to offer Roth conversions of prior pre-tax 403B contributions in the near future.
Additionally, Chapter 551 of the laws of 2024 was signed and became effective on December 11, 2024. This law gives any DOE employee who's an active BERS member in a UFT represented title to transfer their membership to TRS through December 10, 2025. BERS has received approximately 3,100 transfer applications under this provision. Now turning to our financial performance, BERS combined net position increased to 11.17 billion, representing a 10% increase from fiscal year 2024. The qualified pension plan closed the year with a net position of 7.62 billion, and the TDA program ended at 3.54 billion. Total investments reached 11.78 billion with a return of 9.17%. The fixed investment allocation consisted of 47% equity, 28% fixed income, and 25% alternative private investments. Total contributions from both employee and employer amounted to 456 million, while the benefit payments totaled 525 million. QPP's net position as a percentage of total pension liabilities stood at 102.56% for fiscal year 2025, with a funding ratio of 94.8% based on 2023 valuation. Finally, I'm proud to highlight our continued recognition for excellence in financial reporting. BERS received the Certificate of Achievement for Excellence in Financial Reporting for its fiscal 2024 ACFR, as well as the Award for Outstanding Achievement in the Popular Annual Financial Reporting for 2024 PAFR. Our fiscal year 2025 ACFR and PAFR are available on the BERS website. Thank you.
Yeah, first, I'd like to congratulate you on getting the GFOA award. But secondly, and this, and I hate to beat a dead horse, just coming back to these expenses and the listing of the assets. This is the third pension plan being presented to us this morning, and every single one of them is different. NICE is listed 40 top assets, 40 top bondholders. Teachers only reported, I think, 15 at the top. Here we have 50. We have management fees. There's no totals at the end. There's no way for anybody, especially this body, to compare them. And I don't know how we get them to be consistent so that we could look at them and make better types of comments. And these fees are substantial. So, that's all I have to say about that. Does anybody else have any issues or questions?
I have the same kind of comment. I mean, I see some of these things down into $1,900 and some at $2 million. It doesn't make sense. And there's even one where the amount is a negative number. I don't know how that could be, but it's $301,000 odd negative. How can that possibly be? That one I'm just curious about.
I guess we're making money off the fees.
No, it's a negative number though.
I know, that means we didn't pay them.
Yeah, I mean, it means they paid us.
Mm-hmm.
I mean, that sticks out. I don't know what it means. Anybody have an answer?
If I can, we in the city have been talking about trying to consolidate the various pension systems, not all of them into one, but where it seems to be there would be a very good interests.
No, but that's not what I'm talking about.
I mean, we know that that's not going to happen anytime soon, but it does seem, I think, from what we're hearing from everybody here, is that there should be some homogenization among fees being paid by the various pension systems. And that might be a good thing to begin to talk about. Like, why are the pension systems, some of them paying more and some of them paying less, and they're paying more, but not if they're getting more. And I think it would be an interesting and probably, profitable thing for the city and for the people who are, retirees and people who are paying into retirement to have some discussion among the various systems so that you could use all of that heavy leverage would have into getting your brokerage fees sort of a bit more uniform and maybe down a bit. I know that that's something that many systems would not feel comfortable about, but I think that at least starting a conversation among the systems about what they pay for fees and what they get might be helpful, I think, to the retirees and to the people paying into the retirement. Because this is what we're hearing, after each particular discussion.
I agree with that, but the point I was making here, if you go to page, I can't find the page, it says that there was a negative amount in the payment of $301,000 odd. So
I don't have it in front of me, but that could be a clawback on the alternatives.
well,
It's in page
certainly
98.
calls for some
98.
explanation. It's the only one, the only negative one in the whole pile.
It's the very top, 301,000. There's no assets. Carlisle Group.
Yep.
Private.
Yeah, it's alternative private.
Yeah, it's a private. That could be. We could look into that, but it could be a clawback.
Well, it stands out as an unusual number. And I, for one, would like to see an explanation.
Well, one of the points I just also wanted to make, based upon a prior comment, is that when investment managers are hired, we don't negotiate different fees for different systems, right? But different systems decide to either hire a manager or not, or get into a specific strategy or what. So that's where you're always going to see variations between the systems. But if we hire an investment manager and we do it all at the same time, we're going to have the same fee rate for all the systems. The same with on the alternatives, they generally negotiate all the systems together. So the rates that we're paying are going to be the same. It's really the differences between what the asset allocation is and whether each of the boards decides to hire a particular manager. That varies.
Okay. Well, still doesn't tell me how you end up with a negative.
Could you define for the
That was
minutes?
that was the comment prior to yours.
Could you, just for the minutes, could you define clawback?
Well, in general, a clawback provision would be a part of a contract whereby if a manager does something in violation of the agreement, we would be able to basically reclaim a portion of fees that we've paid them. It's not an uncommon structure to put in place for these. It could also have been a fee rebate or something along those lines that came in, after the fact. In my experience, these things always have reasonable explanations, and we're happy to look into it and follow up on it.
Listen, I'm sure it does. It's just in the last couple of days, I've looked at over 100 of these things, and this is the only one I've seen with a negative number.
Yeah, I think your point is if there's something negative and unusual, we should footnote it and explain what it's for, what it is.
Otherwise, nobody's reading this damn thing anyhow.
Just, well, we do. All right. Anybody else have any issues, comments, or questions?
I'm just looking.
Just a
Anybody know?
comment. Just a comment.
Okay.
The rating agencies read these.
Yep. Uh, I also see there's no comments in the management letter. So, like, excuse me. I'd like to thank the members of boroughs for their presentation this morning. And once again, congratulations on your award from the GFOA. And the next item up is the police pension fund.
Thank you.
Where the hell is that phone coming from? Hello.
Hello?
Oh,
Hi, everyone. Can you guys hear me?
Yeah.
Just going to do a quick intro. My name is Stanley Thomas. I'm the Chief Fiscal Officer for the New York City Police Pension Fund.
Hi, everyone. My name is Anna Russo, and I'm the Director of Accounting for the Police Pension Fund.
Nicholas Leonardos, Director of Internal Audit for the Police Pension Fund.
All right, I'm going to just jump right into it. It's a pleasure to see you guys again for the New York City Audit Committee meeting. Like I said, my name is Stanley Thomas. I'm the Chief Fiscal Officer at the Pension Fund. I have our Director of Accounting and our Director of Internal Audit with us. The fund's net position, restricted for benefits, increased by $3.6 billion, which is 6.2 to $62.2 billion for fiscal 25 compared to fiscal 24. The increase was and the increase by 4.3 billion to 58.5 billion in the fiscal year 2024 compared to 2023. Increases and decreases in the fund's net position are primarily due to the fluctuation of investment returns, contributions, pension payments, and withdrawals. During fiscal 2025, member contributions decreased 19.3%. As compared to the previous years. Decreases in members' contributions are due to, for this particular year, was due to cut in active members' overtime, decrease in earnings, and our own members' voluntary and required contributions. In accordance with the pension plan requirements, certain members under certain conditions may elect to increase or decrease their deductions. Benefit payments and withdrawals were 4.65 billion, and our administration expenses were 32.2 million. As of June 30th, 2025, our portfolio asset consisted of the following categories. U.S. domestic equities was 27%, fixed income was 36.9, international equities was 6.5, emerging markets was 3.2, private real estate and private equities was 19.1, hedge funds was 6.2, and the overall portfolio return was 9.7. The asset allocation for our superior variable supplement fund was 65% in equity and 35% in fixed income. The total portfolio return for that fund was 13.2. Our police officers variable supplement fund consisted of 67 in equity and 33 in fixed income, and that portfolio return was 13%. Overall, just speaking about major items that's going on at the fund, as discussed in previous years, we are undergoing our COPS 2.0 project. And we are in this particular fiscal year, we were focusing on post-production for our rollout 2, which we went live in November 2023. The system has been operating smoothly through this period as we transition to steady state operations. Rollout 1 remains steady with no issues. And the project also advanced in different aspects of Rollout 3. We're also starting our validation for to make sure that components of Rollout 3 are accurate and will be delivered as designed. The overall program still remains on track to be completed in 2028. But just to end off, overall fiscal 2025 was a great year for us, especially regarding to investment returns. But I wanted to take the time right now to just acknowledge the Comptroller's Office, the Actuary's Office, the Bureau of Asset Management, and Grant Thornton for the phenomenal job all of us have done to put this ACFR and our financial statements together. It truly is a team effort, so I really do appreciate all of you. Thank you.
Okay, thank you. And once again, congratulations on getting the GFOA award. And once again, this is the fourth presentation with the asset, the fees presented totally different. The prior three identified the top bondholders, the top stock items. This, unless I missed it someplace, I couldn't find it in here. The fees were broken down in the others to brokerages, fees, and numbers of shares. And this is just one complete list. And once again, the total fees is almost $511 million. And I believe that is even more than NICE's. And I guess we only see this because we have them all all the information presented to us at one time, and it's sitting in front of us. If you take these statements by themselves, we might not have had these questions. But somebody should be looking at all of this. And as what was mentioned before, there has been lengthy conversations in the past about trying to merge all these. Mark has always raised the questions, is it possible one retirement system's buying and the other retirement system selling with two different brokers at the same time? And I guess my concern is statements like this combined, seeing all five at one time, highlight those items. I don't know if any other members have anything to add about that, but we've talked a lot about fees this morning.
I have a question, Mike. My first question is, did I hear correctly? Did you say that overtime was reduced? Did I hear that correctly?
So obviously we administer all the pension benefits for the active uniform members of PD, and so PD had made decisions to cut the overtime for the active uniform members, which would result in the members' contributions reducing.
Now, if you could just clarify, I don't know if you actually have this information. Did the city reduce overtime for the older members or the younger members, or do you know?
So the reduction of overtime would be an admin decision made at PD. The police pension fund does not have a say or any influence in that.
I got you. How much was the reduction? Do you guys know in total?
No, I'm sorry, I don't know off the top of my head.
All right. Because I mean, it's a shocking thing to hear that there was less police overtime last year than it was the year before. I'm amazed. And the only other thing is I'd like to agree that it really might be time for the pension groups to at least sit down, have some kind of conversation about, working together to have the fees be at least closer to each other than what we're seeing today. And in fact, maybe, you have more muscle if you're all together and maybe you would pay less. So I would urge that at some point there's something like that happens.
I
appreciate that.
Ask some questions, if I may. There's a reference here to litigation income.
Mark, what page?
Yes.
I'm on page 81. what does that mean in this connection?
Litigation income, off the top of my head, I believe that's when we have any security litigations that comes from the investments that we participate in. So we allocate it separately when that litigation income
I
actually
don't
comes
remember
in if we
seeing.
win a case.
If that's what it is, and I suspect it is, it's interesting that you're the only one that's shown it. Just, that's something. Now,
We just not to speak to the system, the sister systems, but that was just our historical practice.
I'm afraid somebody's calling me in a line I can't find, so forgive me. When you get to page 83, you have a line that says opportunistic fixed income and nothing on it. I wonder why it's carried.
So the columns that are you referring to the second two columns?
Well, if you
for
look
that
at
line?
this thing, it says you have something on the left, opportunity fixed in. You have something called, whoops-de-doo, let me find it. It's called opportunistic fixed income, and you have 4 blanks.
And the same thing is on 24.
Yeah, I mean, it just looks
Gotcha.
so. Then,
Yeah, so that might be just a reporting that we just left it there from previous years, but that's something that we could easily address in the
yeah,
following
now
years.
you have something on page 85, which I'm not familiar with at all. You call it opportunistic, economically targeted investment manager. Can you describe what that is?
So, economically targeted investments, it's a carve out whereby we're making investments, and this is true for each of the systems. It's about roughly 1% of the overall allocation, but those are mortgage backed securities, whole loans, and some real estate investments in New York City specific properties. So it's kind of a long-standing investment carve out that we've had. I believe
Okay, I
police.
wasn't familiar with it.
Gotcha.
It's interesting. Let me just see if there's anything else here. Yeah. Oh, if you go over to page 102, you've got 3 or 4 security positions for peanuts. Why do you bother with them? One for $3,000, $2,000. It's hardly worth it. Just the
So
type.
there are always positions. There's always positions where we're waiting for, it could be a receivable for a reclaim, and sometimes it takes a few years in some of the foreign jurisdictions to claim. So we've divested from the manager, but there's still things within the accounts. So that's why you're seeing some, you'll see some residuals, but we're always reviewing all the accounts to see whether or not it's a good balance or whether it's something that needs to be written off. So, they're just I think a matter of the circumstances of waiting to, totally liquidate an account.
Okay.
And just to piggyback on that, I know it's smaller dollars, but just to represent the entire amount is why we include it in there.
Okay, I figured as much was an answer. Now, we've got one more question and then I quit. It's hard to find it with all these pages. Oh, the heck with it. Mike, I quit.
Anybody else have any comments, issues, questions?
Oh, wait a minute. Wait. Sorry, here it is. When I get to page 139, the schedule investment expenses, there are big numbers in parens. What does that mean? I mean, there's one for 400,000 and 873,000. What is that telling us? That they're in, that they're,
Those are, I think, those are similar to the topic that you brought up for one of the other systems, negative fees that came up. So I'm pretty sure Lynn or Dan could give a better breakdown of those.
I think there's another instance where we can take that back and give you a more fulsome explanation, but it really it comes down to either a rebate or a clawback or something like that in all likelihood.
Can I interject for a second, just because I feel like my PDF version of this document is different from what everybody else is looking at, because I go to page 139, I don't see numbers in parentheses that the previous
you look
Mark
at
was referring to.
Total fee, it's in the total fees column. It's about 10 items down from the top.
The 417 and the 873.
Yeah.
Yep,
Okay.
that's
All
it.
right. All right, because
That's it.
previously Mark was referring to a bunch of blanks in a line that I didn't have blanks in, so.
Well, the more interesting one is you have on the prior page, you've got private equity for 0, which is just amusing.
See, and this is another, in this schedule, they don't have the asset values like the others had. And you're like basically seeing 4 different schedules. Every one is totally different.
Yeah, I mean, you have, for example, on page 140, you've got $10,000 of negative fees. And you got that on the next page too. So you're collecting fees from people?
I think that
Not
goes
all
to the
the
same
time.
premise that
It's a funny thing to look at.
I mean, just following it, there's one on page 138 that has a 0.
Oh,
So
that's different. I didn't
I don't
find.
know if you have any assets that you're holding for that.
Yeah, I noticed that. But if you go to the next page, Mike, the total fees are, one is $470,000. Another one is $873,000. Those are big numbers and they're not explained.
Mm-hmm. All right. Are there any other comments or questions? Because, I mean, basically, we've talked about fees 4 different times on 4 different looking schedules. And, you know, like if there's no other comments or questions regarding the financials, I'll move off to the management data, for which there's 1 comment. So, I don't know if police wants to make the comment or the auditors want to give us an explanation for the comment.
So this comment is a recurring comment. I think we've had it pretty much every year for the past 6 years, maybe. Again, similar to the other finding on NICERS, we have a segregation of duties matter that was identified related to COPS 1.0 application. In this case, the IT professional noted that the 2 IT personnel maintain security administrator, change development, migrate changes to production backend database, and elevated batch job access. Excuse me. And again, management has provided a response and that we're comfortable with. I think when COPS 2.0 is implemented, I think some of this should go away, is my understanding.
But at the very end, it says management will also review options to augment the staff. So what's the status of that?
So regarding to the staff, you know, that would require us to go to OMB to get additional funding. We have submitted the request to OMB, but not particularly for the database admin. So that's something that we would have to work with OMB to get additional headcounts for those positions. But we believe that this finding would go away once we go live with COPS 2.0. COPS 1.0 has some deficiencies just since it was built over 20 years ago. So I think that's where this current status is for this finding.
All right. Does anybody else have any comments or questions? I thank you for coming this morning, and once again, congratulations on getting the award. And next item on the agenda is the Far Air Pension Fund.
Good morning, everyone. Can you hear me?
Yes.
Mike,
Yeah.
I missed it. Which fund are we now on?
Fire pension.
I got it right in front of me. Okay.
Great. My name is Amar Dayal. I'm the chief accountant for the Fire Pension Fund. With me, I have the budget director, Simone Sawak, the deputy chief accountant, Winnie Lin, and accountant, Hanji Chen. I'd like to begin. I'll take this opportunity to thank the New York City Audit Committee for having the New York City Fire Pension Fund present its annual comprehensive financial report for the New York City Fire Pension Fund for fiscal year 25. In addition, I'd like to take this opportunity to thank the Controls Office, the Actuary Office, and the auditors, Grant Thornton, for the collaborative approach of making this process as seamless as possible. Our ASCFR contains a combined financial statement and disclosure of the New York City Fire Pension Fund, the Qualified Pension Fund, indicated as QPP, and two additional funds administered by the Fire Fund. The two additional funds are New York City Firefighters Variable Supplemental Fund and the New York City Fire Officers Variable Supplemental Fund. For fiscal year 24, in terms of awards, the fund once again was awarded the Certificate Achievement for Excellence in Financial Reporting for fiscal year 2024, issued by GFOA. Investment. The QPP portfolio of $22.3 billion returned a gain of 10.1% for fiscal year 25. The fund investment performance reflects a significant gain across most assets. This gain was above the actual assumed rate of 7%. Investment return for the variable supplemental funds for firefighters and fire officers, they posted gains of $469.4 million and $374.0 million, an increase of 13.2% and 30.1% respectively. At the beginning of the fiscal year, the combined net position was approximately $21.1 billion. The fund closed the year at $22.9 billion, which is an increase of $1.7 billion, and which reflects an 8.5% increase. Members' information. During fiscal year 25, the fund completed applications for 1,037 new members and conducted 3 probationary classes. These probationary firefighters have since become members of the fund. The Retirement Counseling Unit consulted with numerous prospective retirees and processed retirement applications for more than 605 members. These applicants are now receiving 90% of their expected retirement benefits. Members' contributions for 2025 were approximately $133.6 million, which is 10.3% lower when compared to FY24, $148.9 million. This concludes my presentation, and thank you. And I'll take questions or comments.
Well, first comment, congratulations on getting the award. The next comment just continues from the other 4. This is the 5th different pension plan where the fees and the schedules are totally different.
Yep.
You basically, identified the highest bonds, the stocks. What's interesting here is you have an average cost per share. The others didn't. And once again, everything is totally different. The others had assets under management. You don't have it, but you have the column all over the place. You
Which
don't.
page are you on, Mike?
I'm looking at page 139. You also have lots of items, assets, average assets under management, a dash, and the fees are dashes. So the reader is left saying, why is this even here? You have no assets and no fees. As Mark pointed out, there's lots of negatives. I even came across a negative that you even have assets. But once again, like all I'm pointing out is this is the fifth different pension plan that we reviewed this morning, with every schedule totally different than the other four.
So, starting, if you go back prior pages, Mike, you'll see the assets under management. There's something filled out in the schedules. So if you go from 137 and then 138 onwards, you see the column, but there's no assets under management, but those are different types of expenses, I believe.
Yeah.
Like legal expenses and such, related to the investment.
That should be highlighted, because if I'm looking at this page and I'm looking at 139.
Yep.
And I see average assets under management.
Yeah, so maybe that's
like with the impression there's no assets.
Okay, so we'll definitely
revisit
revise that in, next year's presentation. But it's like it's kind of like the same schedule, so it has the same column headings. But if you flip back, you see all the investment managers with the different types of securities, and you can see the assets under management is populated under, that column.
One other comment, Mike, is that this is Schedule 4A, and for consistency, we keep the headings going all the way through the schedule.
Right.
Even though maybe we should put under this, we'll revisit this and probably put some dashes and saying that like there's no related cost with those items.
No, I hear you and I appreciate it, but I'm still left with the impression that we just reviewed, this is the fifth pension system.
Okay.
And every single schedule or section that these schedules appear in are totally different from each other.
Right.
Mike, we're in accordance with GFOA, as you know, we got the award. The schedules, we present them the way they're given to us, and we and we try to give as much detail as possible. Like if you go to page 104, which is in the previous with the previous funds, we have our schedule of investment expenses, which comes up to 202,452,000. Our detailed schedule tie into this amount.
Yeah, but let me be frank with you. Your total assets are $23 billion roughly.
Excuse me, 22.3 billion.
And your expenses are 202 million.
Yep.
NICE's has over 100 million, and they're and their expenses are double yours. Yet their assets are 5 times yours. So looking at all these things, and if you've been there all this time, you heard our concerns.
Yes, I do hear your concerns.
All right. Does anybody else have any issues or comments or questions?
I don't know who, maybe the controls office can address this much more clearer than the fund can.
Oh, I mean, basically, somebody has to look at all the pension systems, and and you're all responding to the GFOA, guidelines, the GASBs, etc. And all we're looking for is some consistency across the city's pension systems. That's all we're looking for, but with better explanations as to what's going on. If you heard them, we have negatives. Like maybe there should be a footnote that says, like these are some of the types of negatives. You have items here, no assets, no fees. Like why are they there? If they're rounded out, they don't have to be there.
Right, so let me just
Some of
add, Mike, to your statement
Yeah,
about asking for consistency. We want informative consistency, right?
correct. And as what was mentioned, this committee over the past has discussed a lot of times pension plans, especially the investments. So like that's all. Anybody else have any questions about?
Just one comment I just wanted to make. So I think what we can do is maybe Jack and Katrina, we can kind of get together because we provide all the information, BAM, in a standard format to all the systems. Everyone gets the same. So maybe we can see, for the following year, what consistency we can try to achieve. But that really is among, each of the systems historically have had their own formats. But we also can provide some of the questions that you brought up today when we provide the information to the systems, some of the detail in a standard format on some of the things where there's negatives or zeros and assets. So we'll keep that in mind on how we can when we provide the information. But I think it's an overall bigger discussion on how we standardize.
It's a very big discussion, especially like what I pointed out, the great differences between the fees and the assets as you compare one system to the other.
Yep.
It'll again goes down to timing of investments, asset allocation, differences in manager choices between all of the systems.
Mm-hmm. All right. Does anybody else have any issues,
Yep.
comments,
Take a
or
look
questions?
at page 75, equity securities, level 1. That description is a little different between that which is used in other of the pieces. Level 1 of the fair value hierarchy of determined value using prices quoted in active markets issued by pricing vendors. Actually, it's the transactions at that level. I think that you ought to take a look at whether this description is consistent with what other people are saying. But that's
Okay, we will.
We'll take a look at it.
I have something on a different topic.
Okay.
Which I think, as I recall, this came up during the experience study with the fire pension, that there was some information that was sort of needed for that the pension system wasn't able to provide because of, as I recall, kind of lack of resources. And so we kind of had this discussion, well, our guys, aren't you corpus funded? And then that can't you, kind of devote some resources to like finding this information. And then the answer was, well, but the fire department and OMB kind of control the budget, even though it's corpus funded. And so that was resulting in, I can't remember exactly, some kind of finding about the inability to provide some information. And I'm wondering if anybody recalls that and if anything came of that. I know that's a little vague, but sorry.
We'd have to go back and look at the experience. This is the prior experience study that you're talking about, Marcia?
Yeah.
Okay, we can go back and take a look at that. But the voting structure on our budget is still the same. We do have to have OMB and comptroller agreement before our budget appropriation is approved by the board.
Right. Okay, sorry, I can't be more, I couldn't.
No, it's fine. We can go back and take a look at that finding,
okay,
and we can
All
get
right.
back to you.
Okay, thanks.
just to show you that I'm consistently pained. You use the capital D for city in some places, in some places you don't. The official name It's the city of New York. So you might look at how you'll do it when you proofread it again.
Okay.
Okay.
Thank you.
Are there any other comments, issues, or questions regarding the financials? Because there are no management letter comments. So, I'd like to once again congratulate you on the award and thank you for coming this morning. The next item on the agenda is the
Thank you.
OPEB. Next up is OPEB.
OPEB, huh?
The New York City Other Post-Employment Benefits Plan.
Yeah, without the capital T. This is a skinnier one.
Uh-huh.
Good morning. Good morning.
Good morning.
Thank you. Good morning, all. Thank you for the opportunity to present the FY 2025 Other Post-Employment Benefits Plan financial statement today. My name is Anthony Odose, Unit Head Accounting Services at OMB. In attendance here today, I have Shirley Yu. She's online, Zoom. She's representing Miscellaneous Budget. She's the Deputy Assistant Director. Also here, I have reps from New York City Office of the Actuary, led by Tom O'Hara. The highlights. For FY 2025, the employer's contribution was a total of $4,062,495,000, an increase of about $865 million. That represents 27% over fiscal year 2024 amount. For FY 2025, there were no prepayments or discretionary contributions. Also, net investment income was about $184 million for FY 2025. That was a decrease of about $42 million, representing 18.5% from FY 2024. That's due to net unrealized loss in interest income resulting from market conditions. In addition, for FY 2025, benefits payment by the OPEB was a total of $4,059,659,000, an increase of about $356 million, representing 9.6% compared to FY 2024, as a result of an increase in insurance rates and retiree members. Total net position restricted for post-employment benefits other than pension payments at the end of FY 2025 was $5.2 billion, an increase of about $187 million, representing 3.7% increase from FY 2024. At the end of FY 2025, total OPEB liability increased by $1.1 billion because of investment security purchase price payable at the end of June 2025. This has to do with investment securities that were purchased in June but had settlement dates in July 2025. The subsequent event had to do on August 28, the mayor and the Office of Labor Relations announced a joint proposal between Emblem Health and United Healthcare to self-insure the comprehensive benefit plan for actives and pre-Medicare retirees. The proposal was ratified by the Municipal Labor Committee on October 1st, 2025. The new plan came into effect on January 1, 2026. In light of the timing of this change, the valuation has not been reflected. I now open the floor to questions or comments.
I'm looking at the page 10 here, where I think there may be some typos that under the June 2025 measurement, the third paragraph talks about the $5.5 billion change in assumptions, which then says resulted primarily from two changes. The first one being a loss of $6.8 million, and the second an increase of $12.8 million. So it's hard to see how a $5.5 billion change comes from a $5 million net change. Is that, am I looking at this wrong? Is that a typo in there? With the millions and the billions?
No, my number actually came from, if you're referring to the 5.2 compared to this number you mentioned, 5.5, this number is, it came from the Office of the Actuary, whereas the number I gave was the actual result.
Okay, well, I'm reading what's in the report on page 10. So that's what most people would be looking at.
It should be in billions, not millions.
It's billions.
Okay.
Yes.
All right. Right. It should be billions. That's what I thought. I just wanted to, it stuck out as a kind of major typo, but thanks.
No.
I have a question on the page 8. The net income decreased by $41 million, change in unrealized gains or losses of 4. Net income increased by $73 million in that year, primarily due to an increase in interest income. Now, that's that in effect says that the whole increase was an interest income increase, and you don't know what happened to the market value of the securities.
I believe 2025 we saw the Fed began interest rate reduction, and that affected the interest income. Whereas in 2024, interest rates were largely higher than 2025.
No, I understand, but what the interest income increased almost $73 million by net invest income increased primarily because of an increased interest. What did that do to the value of the rest of the portfolio?
Well, I can check with the investment managers and provide an answer, but this paragraph specifically relates to the interest income portion of the fixed investment that will attract interest income of the portfolio.
This has nothing to do with the possibility of appreciation or recognized gains. Is that what you're saying?
Correct.
It's my guess is that if we looked at this, that net income, it's hard for me to understand what this is saying. All right, I give up.
I have a question in the sense, has that, because if you've been there so far, you heard us discuss the pension plans with the 5 major systems of the city of New York. Have you ever considered applying for the GFOA award for the Certificate of Achievement?
To the best of my knowledge, no, but my unit can liaise with the other retirement system and see the possibility.
Well, they're basically standalone, so you'd have to make a determination that you might apply. Because once again, like looking at this, and you have basically at the end of the year, you're holding 6 billion, almost $7 billion in assets, yet there's no fee schedule. Now, I don't know if you have any fees or anything. But like, as the others had mentioned, they're complying with the GFOA GASB statements. So, looking at this, I'm saying, why hasn't an application gone to the GFOA for the award? And I just don't know of any prohibition against your entity to doing so.
Yes, we will consider it, and if it works for us, definitely we would apply.
Does anybody else have any comments, questions regarding the OPEB statements? There is no management letter. Well, I should say no management letter comments. So I'd like to thank you for coming and presenting this morning OPEB's information. Next item on the agenda is to go into executive session. So can I have a motion to go into executive session?
Move it.
Second. Garfield, you can start recording again.
Right. Thank you, everyone. We're back now in open session, and if there's no other business before us that I don't see anything on the agenda, I'd like to have a motion to adjourn the audit committee meeting of January 28th, 2026.
So moved.
Second.
Great, thanks.
Okay, take care, you guys. Stay
All right,
warm.
Yeah, everybody try to be
Stay
safe and be
warm.
warm.
Stay warm.
Yes.
All right, bye.
Alrighty, bye-bye.